Markets are always interesting, and from a U.S. perspective, one of the things that stands out is the earnings collapse, sort of year to date. And I was looking at 20 years of data, and the earnings collapse for the S&P 500, it's actually the third worst out of the last 20 years. And we came into November doing the usual. We expected double-digit growth for 2015, and from November through Q1, we saw an utter collapse. And we went basically a flat line. So we took all the earnings growth expectations out of the U.S. market, which in some ways was kind of remarkable. And I think early in the year, people were kind of freaking out about it. What ended up happening, however, is that it was almost all confined to energy. I think energy earnings were down like 60%. So the rest of S&P 500 earnings, other sectors, it was okay. Second thing, if I characterize sort of Q1 and Q2, a big player was rates. And again, we're still in this tug of war between what I call fire and ice. You have fire of reflation, and then you have ice of deflation. And clearly, most people spend all their time on ice and deflation because of, the great financial crisis, everything we're dealing with, the situation in Europe, all the quantitative easing. So we saw boons, 10-year German bonds go to almost zero. I think 8 bips was the low. U.S. 10-year treasuries in sympathy went to like 1.6. It was one of the worst deflationary sort of scares that got rebuilt into capital markets, both fixed income and equities, since the great financial crisis. So pretty remarkable. And then Q2 comes along. Europe growth is doing better. Yeah, we put in a negative GDP number in the U.S., but Asia's doing a little bit better. And so there was a much better tone. And then you saw this remarkable sort of reflation built back into rates. So you had the 10-year, go from 1.6 or so back to 2.4 today. The boon was remarkable, went from almost zero up to 80, 90 bips today. These are massive moves. And so it had a big influence on U.S. market sectors. So the deflationary winners, like utilities and staples, started out the year doing well. Financials were getting killed, and then we had a teeter-totter into Q2. And then final thing that glues all of this together, and this has been consistent, is deals. We're absolutely in an M&A hyper market, and I think the number of announced deals in April, and I'm sure this is continuing going forward, it's a record month ever for announced deals. And if you think about consistently from the great financial crisis, the consistent buyer of U.S. equities have been the companies themselves. We've shrunk shares outstanding 2% a year because of the buyback. So consistent bid. M&A deals are just that on steroids. So it's confidence as animal spirits coming back to corporate boardrooms, and the company saying, you know what, I'll one up that share buyback. I'm not just going to buy my own company back. I'm going to buy growth, or I'm going to buy another set of assets by doing the deals. And that's been a very steady bid in the market. I think it's driving a lot of U.S. equity returns at this point. So performance in the strategy in Q1, it reflected some of this teeter-totter where early on, right out of the gates, everybody was worried about deflation. We really got hit on the financials. We were getting hit on some of the energies. Again, a key part of the strategy is balance. So I'm not trying to optimize for just one outcome, and that certainly came through. But when we were facing, a lot of deflationary headwinds or sentiment in Q1, I definitely got hit in those two areas, which are overweights, financials and energy. In Q2, that came back, and so financials, I think, are the second best performing sector in Q2. We certainly participated in that, and that drove some performance. We've done reasonably well with a lot of our legacy tech names, like a Microsoft's done very well for us. Healthcare, we've been reducing that sort of big exposure in the strategy slowly over time, but still overweight for us and still finding some new names to buy there. Healthcare has been the leading sector, so we've done fine there. But overall, sort of an unexciting year for the strategy in the market so far, sort of low single digits, and we're in line, more or less, which, again, I'm pretty pleased with. Cyclically for the second part of the year, I see more of the same. So this consistent driver of markets is, again, share buybacks. And we've been, again, buying 2% of net shares out in the U.S. consistently from the great financial crisis. Now that's on steroids, and we're seeing big deals. The key thing for me cyclically that I pay attention to is the credit cycle and animal spirits. We have positive loan growth in the U.S. In fact, it's high single digit. And there's evidence that the critical loan area in the U.S., which is mortgages, is actually starting to rebound and grow because the housing cycle has a bid to it. That was a huge engine of U.S. economic growth that's been dormant now, that's starting to fire up. The bigger thing and longer picture for us, innovation always drives sort of the long cycles. We've consistently from the bottom seen private economic growth in the U.S., taking out the government, of 3% a year. I expect that. You have incredible innovation still coming through in energy and the shale revolution. Digitization in healthcare is driving huge new categories there, and we're positioned for that. And then just general digitization and smartphones and the other things. Those are the real drivers of economic growth, and I don't see that derailed. As always with cycles, they start with fear, they end with greed. These deal activity and these other things, these are signs of animal spirits and greed. So greed is emerging, but I still expect it to be a very elongated cycle. And using a baseball term, 9 innings, I think we're sort of in the 6th inning as we tilt towards greed, and so we still have room to run. The biggest concern for me always is as people feel better about the future, we're absolute by our processes. We value companies on an absolute basis. We buy when price is below value. Well, my opportunity set is shrinking, and more companies we're seeing price above business value. That's a challenge, but we're still finding good absolute value in certainly financials, parts of healthcare, parts of tech, especially legacy tech, parts of energy. Not surprisingly, that's challenging because the fundamentals are challenging. And then independent power producers like Calpine. Those are all absolute values where we think price is well below business value in the strategy. And so we think we're able to still position ourselves well for future forward returns on an absolute basis, which is what's important to me. Again, it'll get harder as we tilt closer and closer to greed, and we're seeing that, but there's still absolutely opportunities for long-term investors like us to exploit.